The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Well, as we get into the month of September, we saw a mostly lower trading day on Wednesday, highlighted by another down day in soybeans, corn a little lower as well. You look over the livestock sector, some triple-digit losses in feeder cattle and moderate losses in the live cattle trade and lean hogs. What are we tracking as we near harvest time across much of the Corn Belt? Let's talk through things with Mike Zuzolo from Global Commodity Analytics. Mike, good to talk with you again. Hope you had a great Labor Day holiday weekend, sir.
You too, Jesse. Thanks for having me back.
Well, let's dive in and talk about these markets. And I think it's important for us to maybe start. I know you did some traveling over the holiday. Let's talk about the weather, the finish to this growing season. And there's been chatter about maybe some of the top end coming off of the yields in parts of the Corn Belt. One has to wonder, especially on the corn side, if maybe some of that's been factored in a little bit here in the last several weeks. We've seen somewhat supportive corn market trade here recently. Your thoughts on this, and let's talk about Illinois, some of the things you are seeing there in terms of some of the drought that has shown up and more.
Yeah, a couple things. I think first, when we talked at the end of last week and going into the 3-day weekend, we had a corn-led rally on the supply shrinking bull kind of taking over, coupled with the September corn contract finding a lot of demand and a lot of pent-up short covering. I think because of that demand, spreads firmed up really nicely when corn went into delivery for September futures. And so corn led the market higher into the 3-day weekend. We came back thinking about, especially for soybeans, as you say, what's the weather going to do to finish the crop off, and what's going to happen with the U.S.-China trade negotiations. Both those things went south on us pretty nicely. We got a better forecast for rain at the upcoming weekend on the GFS model for especially the Eastern Corn Belt. And most importantly, the U.S.-China trade negotiations, I think, actually took a step backwards. I think the trade sees it that way as well because of the big Victory Day parade in China, the SCO meeting in China, and the fact that 3 of the 3 biggest countries that we're negotiating with, India and China, economically and on trade, and Russia on geopolitics and peace in Ukraine, are seemingly walking away from the negotiating table and saying we're banding together even closer. That new East mindset is once again starting to be thought about in the market. So that kind of sets the table for what we saw on Wednesday. And it was a perfect day for the Allendale farmer customer survey to come out. And Allendale surprised the market with the idea that we're going to be close to USDA's 188.8 yield, maybe only 1.2 bushels lower than that is what Allendale came up with. And so this all happened in the midst of me traveling, and as the red line shows us, from Northeast Kansas and Atchison to just south of Lafayette, Indiana. And the idea with me sitting at a 184.2 yield before the holiday, wanting to see what this crop looked like in Illinois especially, I came back thinking, okay, we've got, I think, 1% to 2% to knock off that 184.2, and we could be down closer to 180.5 to 182.5 because of disease pressure and also because of this flash drought. And it really shows up on the Illinois-Indiana border, and it was very noticeable as soon as I crossed the Illinois River, got east of Hull, Illinois, and then got east of Springfield. It really showed up. And you probably saw the same thing at the Farm Progress Show because this picture was taken within about 10, 15 miles of the Decatur exit where the Farm Progress Show is. And so that's Macon County, Illinois. Now, this is where I'm going to connect the dots. If I were looking at state by state and had the survey that Allendale had, Allendale came out with a 216 bushel Illinois corn yield versus 217 last year. This current good to excellent condition in corn right now for the state of Illinois is the worst in 5 years. So I think there's 3 big states that I think maybe we're going to be pulling back the yield and coming back into that 184, 185 level in the next couple months. Can we get it much lower than that before we actually get test weights and find out the kernel depth and disease pressure? I'm not so sure.
Well, and I think about this corn market, especially through the month of August and all the data that was thrown at the market and more, and how we essentially close near unchanged on the monthly close. And then getting into September now, as I kind of mentioned at the beginning, I feel like corn's been fairly supported. What are you seeing when you look at the technical picture here in this corn market, Mike?
It is, but we're shelling corn right now. I mean, we're shelling it in the South. I've even seen some over the weekend in East Central Illinois. Some end rows being pulled off. I've heard here in Northeast Kansas, we've got some wet corn being shelled right now, and talked to a client in West Central Indiana, not far from the Illinois border, that some early corn was being pulled off as well. And so I think it's a timing issue, and that's going to be the tough part about it. If we stay dry, Jesse, I think maybe we'll stay in more of a trading range mindset and not need to go down as much in the corn specifically as maybe we would in the beans. And maybe the beans won't have to be pulled down so dramatically. But it really does go back to the soybeans are what worries me the most in terms of the futures price versus the basis. And so when I look at this weekly corn chart, we've had 3 weeks higher in a row. We're working on our fourth week higher. That 393, 394 level in September corn, which is still on the board. I would say that weekly low that we just have this week is a really big number not to take out, because if we do, we're taking out a support line on the Dees daily chart as well. And I might have to be forced to get some off the combine sales made, because I've hit that 425 to 435 target price to start doing some corn sales.
Well, and as you mentioned a bit about the China piece here and no trade deal over the weekend, I know on the soybean side, this has been an issue. And really, the last couple of days, we pulled back in futures. Ahead of that, soybean basis in many areas has really kind of gotten horrendous, I think is the best way I could describe it. I mean, what are you tracking as we flip our conversation to soybeans? Let's start with this basis conversation. What do you see in there, Mike?
No, I agree. And we're heading, when it comes to the areas that are impacted by the Pacific Northwest bean export market, i.e. the China export market, it is starting to really get painful. And I have heard basis levels that are even getting us into an 850 and 8.25 cash bean price in parts of the Dakotas. But you can see whether it's Aurora, South Dakota, New Ulm, Minnesota, or Dubuque, Iowa, you're seeing a basis level that's really starting to plummet here this month and mid to month last month in August. And you're going back towards those levels seen in late 2022 and also late 2018. Recall 2018 was the last time we really got shut down with the soybean exports to China. And so this is a tale of two cities. And this is where I'm really pleading with the soybean producer to get in contact with me to discuss his and her individual needs, because this is a situation where the basis levels may not be done going down if you're pegged off of the Pacific Northwest and you're getting rains and you're finishing off the crop very nicely. However, if you're in central Illinois, you may be under a situation where this is maybe the worst basis you're going to find in the off the combine sales for soybeans. And with the market still trading above $10 in September beans, you got to ask yourself, why are we trading above $10 in September beans if we're not getting those export sales to China for the new crop? And so I think you really got to start splitting out your marketing in beans. And I think you really got to consider the idea that we've got a pretty substantial premium in the futures market. Is that premium going to hang around once the September goes off the board here at mid-month and after the WASDE report?
We're having a conversation today with Mike Zuzolo from Global Commodity Analytics as we talk more about this soy complex, Mike, and look at the November soybean seasonal here and look at a couple past years, this year plus 2024, and then looking back at 2018 as we talk more about this. And, you mentioned there's some options in the toolbox here. There's some tools in the toolbox here for soybean producers as we look at the board price over 10, basis though struggling in many areas. So when you look at these seasonal moves, connect some of these dots for us.
Yeah, and I got to say, if we stay dry and cool, relatively cool the month of September for the next couple of weeks, say, with the crop conditions ratings going down on Tuesday afternoon's update, we should be going closer to a 50 bushel yield in soybeans instead of the trade maybe thinking we're heading towards 54, 55. But that also could be already baked into the futures cake at this point too, Jesse. And that's really where it goes back to, unlike the corn, the soybeans have such a divergence in the cash market right now because of the lack of business to China and the idea that South America still has an ample amount of excess beans in the pipeline to be able to service them another couple, 3 extra months than they normally do. I've seen numbers as high as 30 million metric tons that the Brazilians still have on the books or in the bins that they can go after Chinese purchases with, depending on what the price is, given our tariff and given the expensiveness of Brazilian Paranagua beans versus where we're at. But this chart's a very telling chart, I think, because this, I think, helps the producer out there who maybe doesn't want to deal with the soybean situation and take a look at it at face value. You've got a 2025 market that could either go towards 2024, where we peak out in mid-September, or go towards 2018, where we drop going into mid-September, and then go pretty much sideways. And I think this is where, as I said a minute ago, this would make a lot of sense fundamentally, seasonally, and cyclically. If we don't get a U.S.-China trade deal, Brazil's got extra beans, we may not be able to go up after the WASDE report very much because we'll have factored in the weather. It'll be too close to harvest for the weather to do much good, and we'll get a fresh WASDE update, and we'll find out whether the basis has moved at all to compensate for any kind of weather problems. And so I think as we get to mid-September, if we go sideways to higher, we're more susceptible to a break to the downside. And I would not exclude the idea that the futures market could move towards 2018. In other words, what I'm saying is 75 cents to $1.50 would not be odd for me to see that happen, given the structure of this market right now. I'm not predicting that, but I think we have to really plan for it.
I should ask you, in the wheat complex real quick, any notes for you there as we kick off the month of September and price action where it's been at? What are your thoughts on the wheat complex right now?
Yeah, the good, the bad, and the ugly for wheat. The good was the export inspections really came through nicely. The bad is that we've got a wheat crop in France that has very poor quality, and so it's going to be a feed grain, but it's not going to be a wheat. So I think 2026, we're going to have a wheat crop in the world that will compete with corn pretty effectively if corn rallies to any degree. The ugly part is the trade can't get off the idea that Russia has got a bigger crop. Their prices have dropped, but they're not dropping immensely, and Ukraine's prices aren't dropping immensely with new crop coming on. I think they're at 3 to 4 week lows right now, and I think that's where the trade is looking at the wheat market and saying this thing is not going to go anywhere. And I think it's going to be up to the USDA with their supply demand numbers globally and domestically here to really change the course. The last thing I'll say about wheat is, with what's going on in China, with the relationship between China, India, and Russia coming together, this new East coming together, how does the wheat and the crude oil market react to that? We've talked about this several times before. That's still a red hot issue. I can say right here, right now, Jesse, at this stage of the game, seeing what I saw over the weekend, geopolitically and rhetorically, what each side is saying, I think we're a lot closer to a major conflict breaking out than maybe we have been in the last 10 or 15 years. And so I think you want to get your ducks in a row in that. If we do have a major conflict, if we do sanction Russian oil, if you don't have your diesel locked in with diesel prices down, are you thinking this through right now when it comes to your harvest needs?
All right, good stuff there. Let's go over to the protein complex and let's talk cattle. I know August, of course, Mike, was a wild month for this cattle complex with plenty of upside volatility and momentum. So far in September, seems to be a bit weaker in this cattle complex. I have to wonder, are we starting to see some of that seasonal demand shift post Labor Day? What's your thoughts right now as we look at some of the beef retail and look at the action in this cattle complex?
Yeah, the good thing about the cattle and the feeders right now is a correction would be very healthy. We've talked about this as well before, at the end of each month after a big surge to the upside. And I can say this, Jesse, working on the 2026 beef outlook for clients that I plan to get out this weekend. This is a brand new chart I just got done doing. And it comes on the heels of some other research I was doing for the special report. Box beef prices, both choice and select, about 50% of their whole move to the upside calendar year to date in 2025 was last month, and that in August. And that really reflects, I think, very highly the issue with what's going on with Mexico and the screwworm and the lack of feeder cattle imports. But I think it also reflects very nicely that the market is very much on target and on point with trying to ration demand very aggressively. And we need to be ready for that, especially if Wall Street breaks. And I think that's the taste of what we got so far this week. Like you said, we're coming up the seasonals. Summer grilling season pretty much over with, and Wall Street has started to waver because of some of these geopolitical issues. I for one, don't believe this is tariffs that's causing Wall Street to go down. I actually think the record high gold prices, the rising VIX volatility index that we see, and lower Wall Street price action are all indicative of the market feeling geopolitical fears. This is not about the tariff repeal by the federal court, if you ask me. So that translates back into beef with the idea that this chart right here, and I'm going to work through this relatively slow. This chart right here is showing us the beef retail price, and we have at the last 4 data points, the United States, USDA 2025, 2026, and then global commodities 2025, 2026. I am splitting up from the USDA in 2026 in terms of beef retail prices, that we will see those continue to go higher. I think they'll actually go up 3.5% from where they're tracking right now. And that's exactly what they did in 2015. There is a natural lag to the retail beef side versus the wholesale and producer side. And so while my choice steer prices for producers go down a little bit, my retail prices go up quite a bit. That helps support the idea that we're not going to buy as much or pay as much at the packer level. The other thing that comes into play here is what we're seeing in terms of geopolitics and in terms of the Federal Reserve and what Wall Street is looking at. The Federal Reserve is talking more and more about cutting interest rates. Well, what does cutting interest rates do? It creates more inflation. And so that right there will create more of a transfer of the inflation into the beef prices. Well, what if the Federal Reserve doesn't cut interest rates because of inflation? Well, then we're kind of trapped with higher interest rates in a stagflationary market, or more stagflationary. So higher interest rates then get to the consumer. The way I see 2026 right now, and there's a lot more to talk about, is the consumer is going to get trapped either by higher interest rates or a higher inflationary pressure. And I think beef's going to be on the front lines of that.
And on the feeder side of the equation, let's take a look at one more chart here before we close out today. I've noticed that feeder cattle futures have had a little more pressure versus the fats so far this week. What are your thoughts as you look at this chart?
Yeah, this makes a lot of sense because, we still have a very tight supply channel of market-ready fat cattle, and the cash market and the box beef prices are still leaning and helping support the fat cattle market. Feeders should be the ones that peak first, especially with a corn low. Now, this trend line, this orange trend line in this chart, very vertical looking parabolic move up in the last 2 months. That's where we did all the heavy lifting of demand rationing when it comes to the feeders. What I'm saying here in this chart is you take that trend line out, especially after the strong close last month, you can pretty easily, I think, go down to the white trend line, which is tracking all the way down at about 330. So a $25 to $35 break in this feeder cattle market is not a bad thing, and it may be a thing to try and capture in terms of the short position. And then the long-term trend line, which is the purple trend line, is all the way back down around $275, $300. You're talking about almost a $60, maybe $75 break in feeder cattle, and you have not hurt the uptrend line whatsoever, which that trend line really can be drawn off the 21, 22 lows. And so this is the kind of market we're dealing with. And I think 2026 especially, but as we get into the October timeframe, be very ready for a correction, and maybe what could be a substantial correction. But then that, if we would get a correction now, that actually may help us later down the road keep some demand intact and I'll be able to raise my fat cattle prices. So that's how 2026 is shaping up for me. I've got to be very flexible with how the market adjusts and how quickly it adjusts. And then I'll go out to the next couple quarters and say, well, we'll pick up some demand if we've fallen back that much.
Mike, always appreciate the insight. Anything final you would mention or reiterate to folks today?
No, just go to globalcomresearch.com, and it's globalcom with 2M's research.com. Get on there for a 2-week free trial. Put in the comments that you'd like to talk about the soybeans or get the special report from the cattle, and I'll get in touch with you.
Mike Zuzolo, Global Commodity Analytics. Always good to hear from you, sir. Have a great rest of the week, and we'll talk to you again soon.
You too, Jesse. Thanks so much, sir.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.